12:45 on the East Coast down here in Miami, Florida. Guy Adami, Dan Nathan, special guest today, Steph Guild, the Senior Director, Investment Strategy at Robinhood for a live market call. Dan, how are you?
I'm doing great, Guy Adami.
It's exciting. Steph, how are you doing?
I'm doing great. It's so fun here.
Big fan of your work, by the way, and we're going to sort of talk about all the things that you're seeing. But I got to tell you, just to start off, the last 24 hours, I mean, we've been here about that long now. A lot of excitement here, without question. People are enthusiastic. Definitely a community being built here at Robinhood, Dan.
Yeah, no doubt. And Steph, this has got to be like your Super Bowl here. So the first ever summit down here, what do we have? 500, 550?
Yeah, it's around over 500 people.
Robinhood.
And we've been planning forever, and it just feels amazing to actually see it.
And the vibe here is really interesting, and the timing of it couldn't be better, Guy. We have an S&P 500 at all-time highs.
Yep.
It's getting up there. We're going to talk a little bit about your targets, but you know, it seems like most of the strategists on the streets are getting pinged with their targets here, guys.
Well, as we're getting into late October, the year's coming to an end very quickly. I think people are going to play catch up. The market's clearly taking its cues from a lot of different things. But let's talk about some of the things that have been impacting the market over the last few hours. Obviously, I think top of mind is going to be Netflix earnings, which we will talk about. But Taiwan Semi last night, you know, we're sitting at dinner. Unbelievable, right? Steph, I want to hear your talk, your opinion about that. But Dan, talk to me about TSM.
Yeah.
Listen, there was a lot of trepidation earlier in the week, as you saw. ASML, this is not a small company. It was a $300 billion market cap company. They sell the equipment that makes a lot of these high-end GPUs that go into these servers, that go into the data centers, that train the large language models. This has been obviously one of the most important themes drawing the market higher over the last 18 months. Steph, when you see ASML go down 20% earlier in the year, and we think about how do these stories, how do these secular shifts work? Well, there's a whole ecosystem, right? And then 48 hours later, you see Taiwan Semiconductor, which makes 85% of the high-end GPUs that we're talking about. Obviously, Nvidia is a huge customer. How do you square the circle of two different stories telling, you know, two different narratives about what's going on?
I mean, I actually don't think it's necessarily two different narratives. Like when you have a big secular shift, there's going to be winners and losers.
Yep.
And I think you've got like a Taiwan Semiconductor, which is certainly a winner in this. And obviously Nvidia has been one of them too. But then you have ASML, which has a kind of still a mixed business when you think about like a little bit more of an older school business and then one that's winning.
So what they're saying, basically, they had these bookings for the current quarter that came in 50% below what consensus was. And I think what you're alluding to is that it wasn't the AI business that they're blaming the weak.
That's what they're blaming. They're blaming the more traditional business. And it sounded a little bit to me like they got over their skis from a cost perspective. And so that's why they're like, oh, we thought the bookings were going to be higher and we spent all this money and now it didn't come to fruition.
Well, we have some real-time charts. I'm looking behind me. Maybe we can throw a Taiwan Semi chart up and you'll see. I mean, we had those double tops and it looked, Dan, for a while like that may hold up. And then, bam, you come out with this report. We're broken through those prior highs and we're trading in this new range. Now, logic suggests, I guess, that at some point we back and fill here. But you know, Taiwan Semi, which is still reasonable on valuation, looks pretty interesting.
So what do they say about past resistance, Guy?
Become support.
So if you just look at this thing, I mean, you know, we've been talking about this on the market call on Fast Money. You know, when you have this sort of move lower like we had over the summer, and then you have this kind of V reversal back, what is the thing that's going to, you know, catalyze to create a new range on a chart? And by the way, we got to give the charts a shout out here.
Well, I was just about to say, I mean, these Robinhood charts are amazing. They're behind my right shoulder. We have them in front of us here. I mean, what they rolled out over again, we've been here for about a day now. You know, what they're rolling out at this conference is, I think it's groundbreaking. And Vlad was on CNBC this morning with Andrew Ross Sorkin. I thought he did a great job. We obviously had our panel this morning, but there's a lot of enthusiasm. I think people really jazzed about all the different things they're rolling out. We had Steve Quirk on, which was really great.
Right. So this isn't, Steph, we want to get your take because this has been, you know, years, I have to assume, in the making to create this desktop platform. And it's a trading platform. It's not a chart. You know what I mean? It's all integrated here. And when I look at this, and we can just show you, I mean, I can double click on, I have Nvidia right here. I'm not going to do it. I can just trade from here.
You can trade from right there. You can trade from the chart. You can create different charts and everything links as you go down your watch list. I mean, it's really super easy to just navigate the markets at any time of day. And then the aura.
Yeah, I mean, it's amazing. I mean, it's a great platform. So, Guy, let's go back to this chart for a second. So, prior resistance, now support. You just said, do we get a gap fill? Look at this trend channel that's been in place, right? You see the massive volume day. So today's volume guy is going to be as big as one of the gap lower days in late July into early August.
And when you see big volume days like today, and I'm not telling people how to trade, but if you're asking me how I look at something like this, if you've been long Taiwan semi waiting for this event, here's your event now. So it's almost incumbent upon you to do something. Now, what does that something mean? Well, does it mean sell a quarter of your position, half your position, or does it mean, you know what, take advantage of probably volatility that's been jacked up on the back of this and maybe sell some upside calls, understanding that does not provide you with protection, but it creates a bit of a synthetic dividend. But I think it's incumbent upon you to do something today to move your feet on the back of this TSM number.
Yeah, and I want to go back to these. And Steph, you just said these aren't exactly two different stories here. So we just pulled up ASML, and let's just focus on this a little bit. So we have two consecutive gaps over the last couple of quarters. So you just said they might have gotten a little bit, above their skis a little bit. When Guy and I see a company who forecasts their business so poorly like this, they don't have that sort of business, it gets our antennas up a little bit.
I think management has never been more important. Like, I think having interest rates for the first time in more than a decade is a paradigm shift for the market, and it is going to make management companies do well or get out.
It makes it that much more obvious.
I want to focus on interest rates real quick, Steph, and let's talk about bond yields, because what I have found interesting, and by the way, it's having no impact on the market whatsoever, but you're very well equipped to sort of speak to this. If you think about since September 16th, I guess it was, when the Fed announced their 50 basis point cut. 10-year yields have only gone higher since then. As we're sitting here today, I think 10-year yields are either side of 4.1%, which is somewhat counterintuitive. People, the optimists will say, you know what, Guy, it's because things have been going so well on the economic front. Rates are going higher because the economy is strong. Thoughts on just bond market?
Yeah, I think in general, it is that. Like, first of all, the yield curve is now positive, right? So we're not inverted anymore, which is also a positive sign. You have Fed expectations, that they're going to cut, but they're probably not going to cut as much as the market maybe wanted it to at some point. And now you've got a 10-year because you do have growth and the market can hold these levels. I think there is a little bit of a side story because you've had some auctions coming that have been tailed, right? The government is going to continue to have to sell treasuries more and more. We know that the deficit is likely to rise no matter what happens with the election. And that's, I think, going to keep a floor on rates for a long time.
Well, I think it's $15.5 trillion over the next 3 years. 3 years is a long time, but I think to your point, the market is starting to catch a little bit wind of that without question. But, with that said, it's not stopping the S&P. And you have some targets on the S&P 500. So let's talk about sort of the way you look at the market. Again, projections are difficult, but you obviously do work to get you to a number.
I had a call in July. I made a 5,800 at the end of the year with 20% chance of 6,100. So now that we've crossed the 5,800 mark, I think maybe that 20% chance is growing. I mean, how I get to it is just thinking that like rates are definitely going to come down a bit on the short end, at least. That's going to drive some more investment. I think the housing market, for example, is going to start moving a bit more too, even if, mortgage rates don't come down to where they were before. And when I think about just like, we are in the fourth soft landing since 1960, and there's a couple of ingredients to that. One being that companies allowed margins to be a bit disappointing. For the last 6 quarters, margins came in more disappointing than expectations. The other thing that you had in all 4 of these historical times was increased R&D and intellectual property, and we're seeing that in the AI space. And when that starts creeping into the broader economy, I don't see a reason why markets can't get to this.
Right. So soft landing clearly priced in is what you're suggesting. And so when you think about what you just said about some movement in the housing market, mortgage rates coming down, we've had that market stuck. Now we have an S&P, like you just said, all-time highs. What do you think about the notion of a wealth effect, right? So, and we had a panel earlier this morning, and Steve Quirk, your head of brokerage here, was saying that despite the all-time highs, a lot of folks don't feel great about the market here. So I'm just curious how you square that circle a little bit.
I think it's similar to, I just had a chat with Meredith Whitney here at the conference, and I think it's similar to what she said, which is like there is a bifurcation in the demographics. Like you have those who make a good income, they are growing their incomes and they're benefiting from a good stock market. And then you do have the lower half that is not really feeling wealthier. And that's why you have companies like the Dollar Tree. Those kind of companies aren't doing better.
Well, that's been fascinating to see how poorly those lower end stores have done. On the flip side of the equation, how well like a Walmart's done. We'll talk about that.
Yeah.
But real quick, Steph, banks have done extraordinarily well now, and it's been for a prolonged period of time. And they're probably taking their cues from something you just said, the re-steepening of the yield curve. Maybe there's some election bias playing its way into that. But are banks telling a story in your opinion?
But there are even within
There
the
are
banks,
the have
there are
and
the have and
have-nots.
have-nots. Like JP Morgan has done extraordinarily well. You don't see as strong a bank in like a Wells Fargo. So I do think like there's still a bifurcation depending on their business makeup. And you saw a difference, right? Like Morgan Stanley versus a Goldman Sachs, and Morgan Stanley has $7.5 trillion now under AUM. They have that kind of business that's more appreciated. So I think it's definitely the yield curve. It's definitely more recently regulation. And then I think it's just also that like banks are cyclical industries. And when the economy is expected to do well, banks should do well.
Yeah. So we've been talking about, again, just to use that expression, soft landing. There's a lot of sectors, you just named one, that are kind of confirming it in a way, right? So if you look at some of the cyclicals like industrials, if you look at transports, they're about to break out. Industrials you would expect to trade well in this sort of environment. I guess the most important thing, I'm not so certain that the banks are trading on the idea of whoever wins and there's the election and there's less regulation. They just put up really good numbers. So whether you're a large money center bank and you're benefiting from higher than expected net interest margins, or you're looking at the IPO calendar, which has been nothing for 2 years, and you're expecting that to pick up, or M&A to pick up, or a whole host of other things. That's what I think the banks are really trading off of. And so they're also confirming what a lot of folks think is just a better expected market. Let's run through some charts here, Guy. Okay?
Yeah, the first chart I'd like to look at, let's take a look at Alibaba, because this is one that obviously, if you think about Alibaba for the last 4 years, and Dan has a long-term chart, it's been an awful stock. I think we can all agree. But what's been fascinating about that stock, I would say it's 7 or 8 times over the last 4 years. You've seen 35 to 50% rallies off of lows. And we're in the midst of one now. And this recent move to about 123 or so got us up to past resistance. It made sense that we're doing a back and fill. But I think the question people have to ask themselves, if they've been in this trade, is now the time to reload, or is it just over? I will sort of say myself, I think we're about to fill those gaps that we created on those spikes higher. And I think you're going to start to look for levels to get back in on the long side, not necessarily to pull the ripcord entirely.
All right, and Steph, we're going to get to your view on China and what's going on here. But I think Guy just made a great point here. We've been asked this question for 2.5 weeks now. How do I get into this thing? A lot of folks are looking at the U.S. and they're thinking, maybe valuations are stretched, or the kind of the steepness of this kind of move. Well, you want to talk about steep, just look at, we're going to go to the FXI in a second, but look at this bubble that was created in a 2-week period. So the guy's point about these gaps, we're going to get to this one that gets us back maybe towards 90, but then you have one back towards 88. If you round trip that whole move, I'm not so certain that's a level you want to start buying, because it really means that there was, fast money into it and they're coming out of it. And so thoughts on, I guess we really want to focus on the Chinese consumer. If you think about this fiscal and monetary policy, or kind of support that it's gotten, is it going to be supportive enough to take stocks higher here?
China has broken my heart several times since 2017, I would say, where it's just been sort of trading in this range. And it just always makes me nervous. And when it was rallying, I felt FOMO coming on, and I said, I'm going to get whipsawed if I do anything here. So I didn't, but I do think it could be different this time. We just have to see what happens with the stimulus. To your point, if it starts to impact the Chinese consumer, I do think this is the beginning of something.
Dan mentioned the FXI, and if you look, we talk about technicals all the time, but if you look at this chart, you'll see a very distinct double bottom. Dan, go back to that prior chart, and you'll see exactly what I'm talking about. And we talked about this on the tape, Market Call, Fast Money, a number of times. And that happened in February of this year when we traded down to 21, which was a similar low that we saw in the fall a couple years prior. And that was the launching pad for this FXI trade. Now, again, it's probably extended himself, not unlike Alibaba. But I do think there's a point where you're looking to reload on the long side. And trading is much different than investing. Trading is about moving your feet, right? you have to do something. Trade the stock, don't let the stock trade you. And I think to a certain extent, Steph, we're seeing that right before our very eyes in this right here in the FXI.
And Steph, like, what do you make of, though, a lot of these charts we just pulled up? They're consumer-oriented names, right? So it's JD, it's Baba, it's PDD, Pinduoduo, So it feels like investors want to get behind a Chinese consumer
because they haven't been around. Like I taking a little bit of a bigger step back, I just think of like China and what they went through during COVID. Like we were free and they were not for a lot longer. That has a mental effect on you. It's going to take you longer to kind of come back to the way life was. Even for us, it took a while. And so I do think like China is recognizing that and they're doing things. I think this first round of stimulus was all about the market to get people invested and thinking about it. Because so much of consumer money in China is in the property market, not so much in the stock market.
I want to talk about some individual names, but I want people to understand your sort of day-to-day job and, how you're interacting with the client base and, what you view your role is at Robinhood. Speak to that.
Yeah, I say I do two things. One is that I form market views and share them with our customer base. I write a weekly blog called Investors Guild, named after my last name. And it's in app and on the web. Obi and I have the week that was every Friday on YouTube, where we kind of recap the week and look forward to the next one for our customer base. The second thing I do is just help guide investment-oriented products internally here. Like how can we build the best products? Knowing what customers want and what they need and how they can learn.
And what do you think today's customer is looking for? I would imagine sort of ease of use and. We have these charts up. You spoke to the ability to trade from them, but that's got to be something that's top of mind. The ability to trade from your phone, to trade from a desktop, all those different things.
Yeah, I mean, it's absolutely true. Like we're not here to tell them what to do. We're here to help them have the best ways to learn themselves. And I would say one other thing, like one biggest thing that people were asking for was tax loss, which is coming. And we announced that yesterday. So what do they want? They want information and they want help understanding how to analyze the information.
So one thing we spend a lot of time doing is kind of focusing on trade setups, right? And so here's a great example, of a catalyst. So I usually start with a catalyst, right? And then I kind of think about what's the competitive situation? What is the options market pricing for? I'll take a look at the chart. I'll try to get a sense for sentiment. We spent some time this morning. I think it was cute, was talking about it, relative strength indices. So I think about a trade idea like as a bit of a mosaic, right? And so I like to take a bunch of different inputs. So let's start with Netflix reports after the close tonight. Implied move in the options market, and we're going to have an options breakout at 2:30, OBQ and myself. So come by that, check it out. We're going to kind of work into some of these kind of ways that we think about using options against underlying positions. But Netflix, implied move guy, 7%. Now, you've been watching this stock for 15 years. We talk about it on Fast Money every quarter the last 15 years. There's always really high expectations. There's always really interesting sit-ups, whether it's going to be, okay, they're going to put through a price increase. What does that mean for churn? Or what does it mean from a competitive standpoint? Or are they moving into kind of unscripted sort of stuff? And what are the costs going to be associated with that? So all these different things. So, guy, let's talk about this thing. It's had a monster run over the last couple months. This is, let's look at it. Here's a 1-year chart. This just puts it in perspective. A pretty good 45-degree angle here. Now, if we want to put it in a 5-year chart, it just broke out. It made a new high here, but it's back and filled a little bit. How are you thinking about this into the print tonight?
All right, so you look at that, go back to that prior chart, because I think those tops are sort of interesting. Now, you made the fact that, we broke through there, but all right, we're sort of flirting with that prior high. So if I'm sitting here without a position in Netflix, which maybe some people are, you say, how do you sort of position yourself? What I would say is you're hoping that they miss. You're hoping we trade down to what is probably the 150-day moving average there in terms of that purple line. It's going to look scary as shit, but typically those are the best trades. And if you go back and look over time, you will see it's happened a number of different times where you've had these sharp moves lower only to then find the buyers a week or so later. So you have to what's funny about trading is you have to be prepared. It can't catch you off guard. And you try to take the emotion out of the equation because typically the best trades are the ones, Dan, that look the scariest.
No doubt. And we're going to go into some of the other aspects of this Netflix. But Steph, you've been in the business for a bit here, okay?
A bit.
So when you take a consumer name like Netflix, that probably 95% of the people in this room right now use it, and they might use it very frequently. when you see a stock go from $700 to $180, okay, and then work its way back over 2 years. So that all happened in a year, okay, the 75% drawdown, and then all the way back up. What do you think? Like, what get us in the mind of this retail investor when they see, because this was a probably very active stock traded on the Robinhood platform for the last 3 years.
Yeah, I mean, our customer base, like they you can see they invest in things they know and use, and they actually like to trade around their positions. So I think Netflix, you look at that chart, it's given you actually a lot of opportunities to take advantage of the volatility. And that's what I think I see our customers do a lot. They get into the position, they keep a core position, it goes up, they trim a bit, it goes down, they buy a bit more. And this is like the perfect stock to do that with, because I see it as like, there's not a lot of competition for this stock, to be honest.
Well, I mean, if you look at it, throw up a Disney chart, Dan, and talk about the lack of competition in terms of just the stock. I mean, it shows this in spades in terms of what Disney has not done and what Netflix has done. By the way, just so you folks out there know, standing over there by the coffee is a guy named Mark Fisher. Fish, I know you hear me, but, you know, he is a legend in our world. And I mention him because what Mark will tell you is, and this is really important, he will say that he's right 25 or 30% of the time, which sounds horrible in terms of trading, yet he's able to make money because he's constantly moving his feet, Steph. He's constantly in front of things. So when I say trade the stock, don't trade, let the stock trade you, that's what Mark Fisher has done his entire career. And I think as traders or investors out there, Dan, that's what a lot of the folks in this crowd should be doing as well.
Right. So that's a great point. So we're talking about Netflix. They report after the close. We're getting a sense for what the implied move in the options market is. We're going to get a sense for the sentiment. We're going to look at the fundamentals. We're looking at the technicals, but then we want to look at the competition. You know, there was a quarter not too long ago where Disney told us that they actually finally went profitable in their streaming business. This was something that people were really optimistic about, I want to say 5 or 6 years ago. Let's just pull up the chart here. By the way, people, it's the first time I've ever used Legend here, and I'm pretty good at it. I mean, like, I'm moving my way around it. So look at the optimism that we saw, you know, after the COVID crash. People were like, oh, we got to be streaming. Disney's got all the content, and this is going to be a huge business for them. And then when they were not delivering on it, the stock did basically the same thing that Netflix had done earlier. It's been banging around the bottom. They can't get it right. They've had management changes, right? And so when you think about that, it brings you back to Netflix. Guy, you've been saying, what's your line that you've been saying on Fast Money for like 15 years about Netflix?
It's Netflix's world and everybody else is living in it. And I will tell outside of a couple different times over the last decade or so, maybe twice where they've had some missteps, they've done everything right. And Steph, this is interesting, I think, also for the people here listening. A lot of times people will look at a Netflix and say, okay, what's the catch-up trade? In other words, Netflix is kicking everybody's ass. Is there going to be somebody that sort of gets dragged up along with it? And what I say a lot of times is if a stock isn't performing in this environment, there's a reason why it's not performing. And you got to stay with your winners. And that speaks to Netflix. And the flip side of that coin, it speaks to some of the problems that Disney's having. I'm not asking you to opine on Disney, but the mindset around that whole catch-up thing.
I think, you know, Disney is something that, you know, they do have this brand, but the brand is not as strong as it used to be. And I think that's what, like, it kind of traded on that for a while. Disney, to me, like, it just has to show that it's starting to get its S together.
Right. Yeah.
No, you know, I mean, it's starting.
It is a family show, guy, but
I know. I wasn't sure. So, but it needs to show that. Like, to me, it's a show me stock now, and I don't think I would touch it until I started to see that. I'm okay missing the very bottom.
You know what's interesting, and so it's interesting you mentioned that. So Disney's kind of off cycle. They're going to report like the first week in November. I love taking a little stock of what happens early in earnings season and see how investors react to beats, react to disappointments. Maybe it's kind of rising tides or you know, lifting all boats. You just never know. So you got to get the vibe of earnings season. So we started out earnings season, the banks all blew out. I mean, like, literally they just blew out and they kept on going. Today we have, let's pull up Blackstone for a second. That's BX, obviously not a bank, private equity company. Look at what's going on in this one here. Blowing out, right?
Do a longer term chart while you talk.
So beat and raises are being rewarded to a point. Look at that breakout, right? So we're seeing that. All right, I want to bring it back to Netflix because Netflix has the ability to look maybe just like this under a, you know, if it's a big beat and a big raise. And so Guy, what are the circumstances that you think would cause this thing to have that sort of breakout here? Because this is what the traders want to play for. This is how you want to use defined risk, possibly using calls, call spreads, selling put spread, taking advantage of this high applied volatility into a print.
Reacceleration of growth is going to be something. Obviously, that whole, like, I'm not a big, as you could probably imagine, like, I don't use any of these streaming services, but for the people that do, the whole password sharing thing, they've seemingly figured that out. So that's one of the reasons the stock has done so well. In terms of, again, playing it, yeah, you could say, you know what, Guy, Dan, Steph, I'm playing for a blowout on the upside. I'm long calls. I'm long the stock. I get it. If you get that, by the way, it's incumbent upon you to do something on the back of it because you're waiting for a catalyst, and here's your catalyst. But, you know, going back to some of these other things, I'll say this. You mentioned Blackstone. That's going to look eerily similar to what we talked about before with Taiwan Semi. Things, pattern recognition in our world, Dan, is so important. Obviously, completely different sectors, but very similar setups.
Yeah, and I want to look at a technical pattern that I think is really interesting here. So this is a 1 week chart, okay? And you see this thing, it had 5 consecutive down days into the print, all right? And you look at this candle here and you see that we were lower. Now we're towards the high end. And so is this going to be a sort of spike bottom into the print? So, you know, sometimes it's really interesting to see how stocks trade into the print. Not that anyone knows anything, but sometimes it gives you a sense for sentiment. And when you see this sort of bearishness into an event, Steph, how do you sometimes think about it? Do you want to take it and say, all right, I better pay attention to this, or it's providing an opportunity?
I think it really depends on the company. For Netflix, I see it being maybe a little more of an opportunity. That's where I bias it. Because I was thinking, like, I look at some fundamentals too going into a print. So valuations are in the middle of its historical range. So it's not crazy. Earnings expectations are not even crazy for the next year compared to their history, like 22% for the next 12 months versus like 37%, you know, for the last 12 months. So I kind of feel like, you know, do I think I actually don't know if the earnings are going to be like blowout. I kind of feel like it will end up being like just like maybe up a couple percent. I mean, it's just a small,
which actually speaks to possibly you made this point, maybe selling some calls into it. You look at that implied move, 7%. Maybe you go a little above that if you're long it.
If you're worried about it, selling puts or a put spread aren't a bad idea.
That's the high end of that's the deep end of the pool. So here's something near and dear to my heart, Dan. Let's talk about gold specifically, but these mining stocks, and we addressed it a little bit earlier today, but you know, the gold market's been on an absolute tear. Gold's been going higher with the dollar going up, with the dollar going lower, rates going up, rates going down. Gold is seemingly working in every single environment. And you look at some of these mining stocks, I think you have Newmont on there. I mean, you're talking about an S&P 500, Dan, at its all-time high, gold obviously at its all-time high, and Newmont is probably 50% of its prior all-time high. So there's clearly a disconnect, and that speaks to some of the things operationally they've done. But I look at the mining stocks, and I say at some point the market's going to wake up and say, you know what, this gold price is here to stay. Operationally, some of these companies are definitely better. For example, I don't know if you know the AMI Clam, Dan. Do you know that?
I've heard of it.
It's the Agnico Eagle Mines.
How's
that
it
comes
come out?
AEM. Throw this thing up, and you'll see. So not all gold miners are created equal. So here, by the way, is the same industry, stock that's done extraordinarily well. So speak to, I know you're not you get in the weeds like I do in the commodities world, but there's no denying, Dan, that gold has done extraordinarily well.
And this is another great kind of trading sort of thing to focus on, is when you have a stock that is correlated to an underlying, you know, like how are they acting? And so like it doesn't always happen like a monolith together. And so it's a great point. That's when you have to dig into the fundamentals. Why is the A and Guy's Clan acting so much better than the Newmont Mining? And so here's one thing that maybe Steph can help me with, because again, I don't know much about gold, but when I look for correlations in the market, if gold is supposed to be this thing that helps you kind of think about a debasement of a dollar, or it's supposed to be like the thing that works when the stock market's getting killed, how is it that gold's at all-time highs and seems to make new all-time highs just as the S&P does? That's not something I've seen a whole heck of a lot in my career.
And no, it doesn't often happen. I remember gold was going crazy in 2011 when, you know, everyone was worried about all the debt we were taking on. People seem more comfortable with the deficit that we're taking on, but I do think it's correlated with that and the expectation that we're unlikely to start trying to cure that deficit. So I think gold is sort of like a little bit of like, we've also got, if you think about it, geopolitical stuff has been really flaring up. And I
100%.
also just think like it ends up being like one of two things. One is like kind of thinking about the deficit, and the other one is a little bit of a disaster hedge, in my opinion. But when you go back to gold miners, you're also investing in the company.
No doubt.
It's not just the commodity.
100%.
And so you do have to think about how they're managing it.
All are managed different, and not
Yep.
all created equal. Now, today is October 17th. We're, I think, 20 days before this election. I'm not asking you to opine about politics, which is not a political show, but there is an election coming up, and one would think that would have ramifications for the market. Now, folks will say, Guy, it's happening right before our very eyes. You see Bitcoin rallying, you see the banks rallying. It suggests a possible outcome. But the importance of the election, in your opinion, for the market and the things that are traded out there?
And this one seems different than the ones I've experienced. I feel as oftentimes it is a weird kind of sideways market beforehand. Sometimes, historically speaking, you go back, volatility rises when the opposition party ends up winning. Volatility peaks in the summer before if it's the incumbent party that ends up winning. We did have a spike in vol this summer.
August 5th.
Right? And then that kind of came right back down. But this time, it just feels like there's just everything is going well. And it's almost as if the election matters less this time.
Well, it's interesting though, because we've had lots of, twists and turns in this election. Let's be clear, right? So I've never seen a candidate drop out.
I mean,
the markets have not been bothered by any of that. So it might be different this time. Hey, really quickly, we have a couple mics here. So if anyone wants to ask a question, feel free to do it. Understand that Guy Adami might get all up in your grill.
No, not might.
Okay.
I absolutely.
He will. So if you are daring enough to do that, get up here, ask a question. Let's talk about some of the things that you are most optimistic about, Steph, into 2025. Assuming that, let's just say, no big geopolitical events, no big change as it relates to the election, or it's not going to be a big driver. Are there some sectors you're focused on? Where do you think some of the best opportunities are? Because we've talked a little bit about the tech trade, very focused on generative AI, right? So we have the big hyperscalers, Google, Amazon, Microsoft. Then we have a bunch of the chip guys, even like stocks like Dell have gotten in on the game, who make the servers. But it seems like there's 20 stocks in an S&P of 500. Now, we talked about some of these other sectors that are doing a lot better. Guys are optimistic about energy. He thinks we're going to come back to that. It's been slightly disappointing. You got to pick stocks there. What are some areas that you're focused on?
So I'm more recently, I made a call on Midcap. Actually, I think I'm publishing it today. But I do think like Midcap sits right. So you just kind of broad Midcap. It sits right in the sort of like, I don't know if you watch the show Curb Your Enthusiasm or if I'm allowed to say that, but
I have never seen
it.
So,
okay, well, one of the episodes is about being a good middler at a dinner table and being able to keep the conversation flowing.
Middling right here, by the way.
I feel like mid-caps are good at middling. Like they have better valuations than the large cap names, but they're not as dependent on, interest rates being lower, like small cap, little higher quality. I just think they're right now in the sweet spot. So and they have started rallying a little bit, but I don't think it's over. I'm also just a big fan of saying that we're in a market of stocks for the first time again in a long time because we have interest rates. Yeah. And so to me, that just means like you're picking good winners. You're looking for single names. You're not necessarily investing as thematically as maybe all you needed to do for the last 12 years.
It's interesting. Those mid caps, obviously very economically sensitive. And within that, a lot of small and medium-sized banks as well. So there's an optimism. Yeah. Before we sort of field some questions, American Express reports, I believe tomorrow, if I'm not mistaken, Dan.
Yes.
The implied move, I think, is 4%. Recently, there was a downgrade in American Express, something you typically don't see ahead of earnings. The stock has done extraordinarily well. There's no denying their brand. I thought it was interesting. Discover Financial reported yesterday there was some concern around some of the loss provisions, some of the delinquencies, yet the market is shrugging that off. I find it fascinating that right now we have an average rate on a credit card in the United States is 23%, $1.35 trillion of credit card debt, and delinquencies now are at 13 years high, north of 7%. But if you were to look at American Express, that tells an entirely different story.
Yeah, so
different consumer.
We got this one up here, and it's kind of what Steph was just saying, this bifurcated consumer. But I'll just, before we go back to, let's go to Capital One. You just mentioned Discover. Now, Capital One is trying to buy Discover. Look at that thing. I mean, that's broken out too. So this tells me more about what stock market investors feel about it and they're being a bit choosier than they are, let's say, within retail, because we talked about the trade down to Walmart and Costco. They're benefiting that, but the dollar stores are doing very poorly in that regard.
Right. And I don't think people are necessarily using credit cards for that. So I do think, again, it's just like the different consumer. American Express is a different consumer. There was some more recent data I think I saw where credit card debt, the size of it has come down a bit. So that's helpful. I also saw this morning a study about generationally, Gen Xers have the most debt. They're maxing out their credit cards the most, and the other generations are not. And I know we just talked to Meredith about how Amex is benefiting from the younger generations actually spending.
All right, so guys, let me
I'm going to tell folks here, if you have questions, come up to the mic. This gentleman has a question.
And give us 1 sec because we want to finish up this American. No, get up there.
Go ahead.
Yeah, we want to see you. But on the American Express front, guy, and it's interesting what Steph just said about the Gen Xers. You know, we saw LVMH. We saw their earnings. You know, they weren't great. I mean, this is a high-end consumer. Now, you can blame it on China and you know what I mean, that sort of thing. So how are we squaring that circle where there's been a lot of weakness on the high end too?
Yeah, but my thesis on that is a little like more spiritual almost in that.
It's spiritual. I mean, you know, Guy,
I like that.
Guy, you're
well, here, real quick, somebody just said, here's a question. Guy, what is your spirit animal? And mine would be a mountain lion, because if you go out west of like Wyoming, they're not scared of grizzly bears. They're scared of mountain lions because they stalk people, and I'm an effing stalker.
Wow.
So there you go. Please.
What about an eagle, though? You just saw eagles at the Sphere last week. I just
although birds of prey are badass. But
I like being an owl, just kind of wise, sitting there. I like to work at night. Anyway, what I was saying is that I think actually that a lot of materialism, like a general feeling of I need to wear the most recent expensive bag. It kind of feel like people COVID that kind of knocked COVID that like I was home. I didn't care about that anymore. And I don't think I'm alone in that. I do actually feel like people are spending on experiences and living life and not necessarily caring as much about designers.
Well, American Express also has this this business travel, sort of component of it, which is kind of interesting. But Guy, last thing before we get to the question, when you see a stock moving like this into a print, okay, this is not, some semi-stock or Mag 7 thing or anything like that. Do you get your antennas up 100%. A little bit? Yeah.
Well, valuation, I mean, this has gotten itself to pretty expensive stock. When you talk about standard deviations from the 150-day moving average, we have reached about 1.5 or 2, and typically this becomes mean reverting. So they better say something great on the back of this quarter, or I think you're going to do sort of a back and fill. Young man, what is your question?
Not so young, but so quick question. I started listening to you guys on Fast Money like 2007, like middle 2007.
Holy shit.
Okay. So
Guy had hair back then.
Kind of right at the top, like things started to fall off. You were talking a bit about transports earlier, things like basic materials. I just wanted to get your take on stuff like that, like something like steel. So
I love first of all, thanks for watching Fast Money. If we make it to January, it'll be 18 years, which is unbelievable. So you started watching it at the beginning, so thank you. But number two, when you think about sort of the nuts and bolts, we used to call it Rust Belt America, they're telling a much different story. So, a lot of it is predicated on what's going on in China that fits and starts. For example, Dan, pump a Freeport McMoran, which is devoid of, there you go.
I'm in your head.
So here's FCX. Now you see the huge moves to the upside, the subsequent moves lower. A lot of that has been contingent upon the underlying commodity, in this case, copper. But copper is one of the most economically sensitive commodities out there. So it's really hard to sort of figure out what's going on right now. There's certain facets of the economy that says everything's great. And then there are things below the surface that are giving you concern. And I'm not making any comparisons to 08, 09, but there are clearly things that sort of got my antenna up without question, Dan.
Yeah, no doubt. Let's do this because you guys, I don't know if you guys listen to this, watch this every day. Guy and I do it Tuesday, Wednesday, Thursday, 1 o'clock. Live on YouTube. We also put it in the podcast store. It's Market Call, MRKT Call. We have a very active message system here on the YouTube. We get lots of questions. Guy, do you want to get to a couple questions? And guys, come up here. Come on.
Yeah. So Curtis is asking. I think this is from YouTube. What's it going to take for Nvidia to break that 140 resistance? So what's interesting about Nvidia? Throw this chart up real quick, Dan. So for you folks out there that are armchair technicians like myself, on March 8th. Nvidia made an all-time high of 120 and change. it closed lower on the day, and we had something called an engulfing pattern. And I talked about it on Market Call. I talked about it on Fast Money. I said that setup you can't ignore, and it should theoretically set us up for a pretty significant move lower. And by April, the stock had traded down some 35%. We subsequently worked it off. And then on June 20th, Dan, if you can sort of go there, you'll see we had the same pattern. Made an all-time high of 140.26, I believe. Closed lower on the day. As a matter of fact, it lost $300 billion of market cap in a few hours. I think that was the largest in history, which set us up for the move that we saw on August 5th, down to $90 and change, which filled a gap, about a 38% move lower. Here we are right back up to those prior highs. What does it take? Well, theoretically, Dan, it should take the Taiwan semi-quarter, or maybe the market's waiting for Nvidia report on or about November 14th, I believe.
Yeah, and what I found fascinating, Nvidia was right up against this level you were talking about. It had a new, actually all-time closing high. I want to say it was that on Monday. And then the ASML news came out, and then the stock got flushed. Well, here we are very quickly back at that. It's not breaking out on the Taiwan semi news. If you could think of one piece of news other than this company pre-announcing and beating and raising that would cause it to break out the way Taiwan semi did, it would be this news, and it's not. So that's kind of interesting. When you see a chart like this, Steph, contend with that prior high, Guy made a great point. There were two instances, and you can see from that horizontal line, that was the March one. You see the June one. I don't know. What is the thing that's going to cause it to break out other than its own beat and raise that has to be above what consensus is right now?
I mean, expectations are everything when you're investing, and I just think expectations are super high for this company, which is why it can easily trade in a range for a while. I actually, when I look at this, I think, I don't know what could take it higher between now and the earnings. So I could see it just drop, go back up, drop. I think it will be in a range until we get to earnings.
Feels that way. Any other questions? Otherwise, we're going to wrap. But I just want to say before everybody's shy. I love that. Steph, it's an absolute honor to have you join us here without question. You're going to come on, Market Call with us or on the tape for sure. Hopefully, we're going to see you on Fast Money on CNBC. I want to thank all you folks for joining us. Thanks to folks in the AV. I mean, it's not easy to set something like this up. So thank you. And thanks all you folks for hanging out and watching. We truly appreciate it. Enjoy the rest of the conference, everybody.
Thanks, everybody.
Thank you.
Thanks.